Hey, it's Owen here with Owen Finance, your gateway to smarter investments, sharper financial insights, and also the ever evolving world of crypto and much more. Ready to level up your financial game? Let's dive in. Imagine you're at a buffet, except instead of choosing fried chicken or salad, you're choosing entire groups of stocks or bonds or maybe even gold. That's basically what an ETF is, a basket filled with different assets. But instead of you running around trying to fill the plate on your own, someone else has already curated it for you. And you're free to buy a slice of that basket on the stock exchange, just like you'd buy a single share of Apple or Tesla. Doesn't that sound more appetizing than researching 1,000 individual companies? The concept is fairly simple. An ETF, short for Exchange Traded Fund, sits on a stock exchange like any other public company's share, but under the hood, it holds a mix of stocks, bonds, or other instruments, often aiming to track an index. So if you've ever dreamed of owning tiny pieces of every single company in the S and AMP Wink with Tongue Sticking Out 500, you can just grab one of those S and AMP Wink with Tongue Sticking Out 500 ETFs and voila. You're basically in bed with all 500. It's kind of like speed dating with companies, except you stay in a committed relationship with the entire group. There's a reason these little bundles of assets are so popular, and it's not just because of their fancy acronym. The underlying structure allows for something called creation and redemption. Don't worry, that's just financial jargon for how new shares of an ETF are made when more people want to buy in, and how they're taken out of circulation when folks want to sell and get out. So the ETF shares move around on the exchange, but behind the curtain, there's a whole mechanism that keeps the share price close to the actual value of the assets inside. It's like a big balancing act performed by authorized participants. Yes, that's a real term, though it sounds more like a secret society. Now, there are many flavors. You can have your basic vanilla ETF that follows a standard index, like the aforementioned S and AMP Wink with Tongue Sticking Out 500 or the NASDAQ, or you can go wild with sector-focused ETFs that only invest in, say, green energy. Or even weirder niche ones that might invest in video game companies, cannabis producers, or robotic AI overlords. There are also bond ETFs, commodity ETFs, even actively managed ETFs where some finance whiz, or so they claim, picks assets. And just like ice cream, some of these flavors might give you a brain freeze if you're not sure what you're getting into. So, what's the big draw? Why do so many people swear by them? First off, fees can be ridiculously low compared to traditional mutual funds. Imagine paying someone 0.5% per year instead of 2%. Over time, the difference is the kind of money that might fund your next vacation. Then there's diversification. That's a fancy way of saying you're not betting the farm on a single company's success or failure. Think of it like wearing multiple layers of clothing. If it suddenly rains, you still have that cozy sweater under your jacket, plus you're wearing water-resistant boots. You're covered from multiple angles, which can help you avoid getting soaked. Another perk is the ease of trading. Since it trades like a stock, you can buy or sell an ETF anytime the market is open, which might feel like a superpower compared to mutual funds that price just once a day. But let's not pretend ETFs are magical unicorns. They're still subject to the whims of the market. If the whole market is crashing, that shiny S and AMP Wink with Tongue Sticking Out 500 ETF is going down with it. Plus, some ETFs have liquidity issues. You might be stuck with something that trades only a few shares a day, making it harder to sell quickly without taking a hit on price. Then there's the possibility of currency risk if you're investing in ETFs that track foreign markets. That's like watching your investment do a roller coaster ride because the euro or yen decided to have a little meltdown. And don't forget the tracking error. Sounds like something the FBI might investigate, but it's just a small difference between the ETF's performance and the index it's trying to mimic. Most of the time it's minimal, but it can be annoying if you're a perfectionist. At this point, you might be thinking, so why not a mutual fund? Well, mutual funds and ETFs have a lot in common. They both give you a diversified portfolio. But mutual funds don't trade on an exchange. You buy or sell them through the fund company or broker at the closing price. That means no day trading your favorite mutual fund in the middle of a Tuesday, which might be a bummer for those who enjoy stress eating pizza while staring at real time price charts. Also, mutual funds typically have higher expense ratios, though that's not a hard and fast rule. But the drama often lies in the fees and the convenience. ETFs are just more flexible, which is why they're beloved by many. Of course, some folks like old school mutual funds for systematic investing because it's the investing equivalent of setting your phone to do not disturb. You put your money in monthly and you don't think too much about it. Speaking of fees, every ETF has something called an expense ratio, often expressed as a percentage of the total assets you're investing. If an ETF's expense ratio is 0.1%, you're paying $1 a year for every $1,000 invested. That might sound like peanuts now, but over a decade, it adds up. Then there are broker fees, which could be free on some platforms or a few bucks on others, so it's always good to do your homework. And don't forget the bid-ask spread, which is basically the difference between the price someone is willing to buy and the price someone is willing to sell. If you ever wondered how the market tries to squeeze you for a little more cash, that's one of the ways. Now, how to get started? You need a brokerage account, which is essentially your personal portal to the stock market. Pick one that has good reviews, reasonable fees, and a user interface that doesn't make you want to hurl your computer out the window. Then you pick your ETF. That's the tricky part. You might want an ETF that covers a broad index like the S and AMP Wink with tongue sticking out 500 if you're just dipping your toes into investing, or maybe you have a moral preference for ESG ETFs because you want to save the planet, or at least look like you care. Some people prefer to go more exotic. There are literally ETFs for almost every theme under the sun. The key is to make sure it has a decent trading volume so you're not stuck holding something that trades only once a month. And it never hurts to look at how long it's been around, how big its assets are, and of course, the expense ratio. Once you've narrowed down your choice, you can either dump a lump sum in there or go with something called dollar cost averaging, which basically means you buy in smaller amounts regularly. That strategy might help you sleep better if you're the type of person who checks stock prices right before bed and wakes up in a cold sweat. If you're going to panic every time the market dips, maybe slow and steady is the name of the game. Now, about taxes. Depending on where you live, you might have to pay capital gains tax if you sell your ETF at a profit. Some places have a time-based exemption if you hold it long enough. Others will tax you from day one, because apparently governments like money. Who knew? If you're a responsible adult, you'll keep track of when you buy and sell, note your gains, and pay your dues. If you're like some people, you might cross your fingers and hope the authorities are too busy binge-watching reality TV to notice your missed declarations. Spoiler, they usually do notice, and that's the kind of surprise you don't want in your mailbox. So that's the lowdown on ETFs. They're flexible, often cheap, can be diversified across thousands of companies or bonds or even exotic assets, and they trade like a normal stock. But they're not without potential pitfalls. You could still lose money if the market tanks, or if you choose an overly niche ETF that nobody else touches. Still, for many beginning and intermediate investors, they're a straightforward entry point into the market. One little controversial hot take before we wrap things up. Some critics argue ETFs can artificially inflate stock prices because so much money just flows blindly into them, especially in the big broad indexes. It's like half of Wall Street is mindlessly buying and holding without truly caring if the companies themselves are any good. That could create weird distortions in the market. But hey, if you're going to distort something, might as well do it with style, right? Jokes aside, it's worth noting that any investment trend can come with unintended consequences, so stay informed and occasionally question the status quo. That's how you keep your portfolio and your sanity intact. All right, that's enough finance talk for one sitting, so take a deep breath, maybe do some yoga, or open that brokerage app if you're feeling bold. The ETF world is vast and not nearly as frightening as it first seems. Sure, it might have some quirks, but if you can handle binge-watching the latest drama series, you can handle a few letters on a stock ticker. Just keep your expectations realistic, your choices diversified, and remember that while no investment is risk-free, at least you're doing more than letting your money rot away in a sad zero-interest account. After all, you want your money to work for you, not the other way around.
Thank you for watching. If you liked the video, don't forget to give a like and subscribe to support us. If you are interested in our premium content, please also visit our Patreon. You can find the link in the description. Thank you and take care of yourself and your finances.